All right, guys. So there is a lot of information out there right now, a lot of, I would say, misinformation. So it's happening where, raise your hand if you've heard that there's going to be maybe 9% or 10% interest rates this year, or the housing market's going to crash. So there's a lot of fear out there, and what this is going to show you and hopefully allow you to have some kind of positive optimism and potential information to give your clients so that you can guide them.
Because we believe 2023 is going to be a great year for housing and mortgage rates. And, supply and demand is what impacts the market the most. And towards the end of this year, as interest rates rose, supply or demand slowed. But we believe that now interest rates will continue to improve, and long-term rates are driven by inflation, because inflation erodes the buying power of a fixed investment payment that investors are receiving. So investors are forced to charge a higher interest rate as inflation ticks up. But as inflation comes down, interest rates tend to come down as well. And we're going to show you kind of this correlation.
And when we know, you guys saw this last year, as interest rates went up, people started hibernating, going out of the housing market because of that price pressure for them and fear. So hopefully we'll give you some optimism. Well, let's go ahead and jump in to the actual inflation and how it drives mortgage rates. So you can see here, this blue line is our 30-year fixed mortgage. And the pink line on the bottom, that is the consumer price index. That's the Fed's favorite reading on inflation. And you can see that throughout time, the last few years, that the mortgage rate parallels the consumer price index, the CPI, fairly well, right up until COVID. So if you notice this QE period, so Tony, you want to talk about QE?
Yeah, so quantitative easing was what the Federal Reserve put in place to help stimulate the economy during COVID and keep things in place. And so they were artificially buying a massive amount of mortgage bonds,
Massive,
like nothing they've ever done before during that quantitative easing period. So during that period, interest rates were driven down because of that buying of the Federal Reserve of mortgage-backed securities. Inflation started to come up, and the Federal Reserve thought that inflation would be transitory. But what they didn't know is that it wouldn't be. And so what we're seeing towards the end of the QE period, you see that inflation is starting to rise, and they end up then finishing the quantitative easing period.
meaning they stopped buying the mortgage-backed securities.
Yeah. And then after that period, you can see that inflation ticked up, and therefore mortgage rates ticked up as well.
And at a faster rate, actually, of inflation, and then surpassing it.
And you see it started to come down, though, towards the end of 22.
And some of you have seen this, and I take a second to explain what this is. So inflation is year-over-year inflation, and the year-over-year inflation takes the entire last 12 months and adds that number up. So the year-over-year inflation you'll see is 6% year-over-year, and that was at the end of November last year. And the way that we see inflation come down is that the numbers replace each other. So for example, November of 22 replaced November of 21. So these yellow numbers were being replaced towards the end of last year. And for those of you who were part of our meetings and last summer, we started saying it might be a little bit rocky, but we've got to get to October. We've got to get to October. And then the October number, which is reflected in the November CPI report, that you can see October of 2021 was a high number, 0.6. And we replaced that with a low number of 0.3. And so that November report that we got, and we again got a really great run on a positive run on interest rates. It was lower, replaced that number, and we've started since then to see market improvement in our interest rates.
Yep.
And
keep in mind now the year-over-year number that on January 10th, the consumer price index, it came out and the current was 5.7 year over year. So we're seeing that number coming down, which is positive news.
Because again, like we just showed on the other screen, the inflation directly impacts our mortgage rates. And keep in mind on this screen, I want you guys, as we move into the next screen, keep in mind April, May, June, because this is going to be really important for this next part.
So one of the biggest components of the core CPI is shelter costs. And shelter costs represent 39% of the core CPI, consumer price index. And what this shows is it shows the cost of shelter over the last 3 years. But when we look at cost of shelter and we're thinking about year-over-year numbers, we're looking at 1 year ago. So we're looking at January of 2022.
So take a look, if you guys remember that previous screen, shelter costs are really high January, March, and we're starting to see a decline in shelter costs starting in about April.
That was last year.
Of last year. And what we'll see is the shelter costs are lagging because it's an average. So we know that there's a turnover in leases. It's a year-over-year change. So this blue number is the lagging reporting of shelter costs and reflection of that time that it takes for leases to turn over. And eventually these will kind of catch up and even out.
And the next slide kind of gives you an example. Think about it as a roller coaster, because on a roller coaster, you ride up to the top, and then as you start to go down, there's a component that's, the real
Over the
time,
top.
yeah,
It's
over the
coming
top.
down.
Yep. And then, but you have the lagging component, and that's the shelter component in the CPI figure.
So really from January, and remember that kind of charting the last two slides until about April, we're on this tail end. So shelter costs are still going to show an increase. And then as it goes over the top, that number is going to end up being reported in from April in the May CPI report. So we'll end up seeing some really great low numbers for shelter costs starting in May. And that means our May report for our CPI is going to have a really, really great positive impact on our mortgage rates. Likely
into June and July as well.
Remember, June, July, all the way in through September, October, those prices from rates from 2022 were all very high. So we're going to get low numbers expected through that period of time. So this is across the board. So again, going back to that inflation report, everything has leveled out and come down except for shelter costs. And again, that's due to that roller coaster lag effect.
Now, this shows mortgage rates typically follow the 10-year treasury. They don't do it perfectly, but they are somewhat in sync as far as historically, as far as how they move. And typically, the spread between a 10-year treasury and mortgage rates is normally about 175 to 200 basis points, which is 1.75% to 2% is what that means. And what's been interesting that's been happening now is right now we're seeing that the mortgage rate spread, the difference between a mortgage rate and the 10-year treasury is about 300 basis points. And why is that the case? Well, part of the value of a mortgage is what's called servicing. So when a mortgage is in place, somebody will pay a mortgage to a company and they think that that mortgage company holds that loan.
And you guys have probably remembered or heard us talk about before that a loan is typically in place for on average 5 years to 7 years. So if a lot of if there's money in the servicing of the loan, they're planning on recouping that money over a 5 to 7 year period. And if we know or believe, and the investors are way smarter than we are, those bond traders, they know more than pretty much everyone else out there. They know that these loans are going to be refinanced. So if you look at 7%,
yeah,
how many people at a 7% interest rate are going to refinance if rates come down? Most of them. So there ended up being this big spread because the value to hold on to that mortgage wasn't there because people are not going to service those loans for that 5 to 7 year period that they were expecting. And so as we see the bonds come down, so we are seeing this, the bond rates coming down, the mortgage rates are starting to mirror that. And now that spread, which was 300, we're already seeing towards the end of last year,
yeah,
is narrowing. So we're about 270 at the end of last year. And if you have a rate at 6%, you might hold on to that loan and that servicing might be in a longer period of time. And they know that it's going to have longer value or more value to it as we hold on to it. Anything you want to add?
no, that's perfect. And then this shows kind of the spread has been narrowing. So over time. So typically that spread is there. So,
and as this comes down even a little bit more, what we're going to see is that value in servicing increases. And so we'll get a faster closing of that gap that was, again, 300 already reflecting towards the end of the year, 270. And hopefully in the next couple months, we'll see it mirroring what the average
to the
is.
175 to 200 basis points. So,
and or coming back here, if it, they're expecting the bonds being around 3%. If it follows the normal historical trend of 175 to 200%, we should start to see rates somewhere in the 5% range.
Mortgage, yeah. Now, there's talk of a recession, and recessions in recession periods, mortgage rates typically improve. And this chart shows that as the pandemic happened, savings.
So
yeah.
recession has been staved off a little bit because we had these, stimulus packages, sorry. So these points in here are the stimulus packages. So this was helping stave off some of the recession. And you can see as people have the stimulus packages gone away, their savings have gone down. And now their credit card debt, which was low, they've used their savings. They're continuing to live in the same style that they were living. So still buying all the same things and going out to dinner, which has been pushing that recession back. And as these credit card balances increase and our savings decrease, that's going to then kind of hit a brick wall where people do have to pull back. And that'll then really help us slide more into that recession.
In periods of recession, and they always then are followed or are predated by the inverted yield curve. So the yield curve,
this is very technical. So Tony's smarter than I am. I'm going to break it down in layman terms.
Go for it.
So if you're investing money, a 10-year investment, you expect to get more return on a 10-year than you do in a 3-month. And that is what we expect. So that's why these numbers, that 10-year is always less than the 3-month, or always higher than the 3-month as far as your yield. But when we see, and this is every single time that they've followed this, when we see that the 3-month yield is a higher rate of return than your 10-year. So you see it here. This always precedes a recession. And it has been there historically, and you can see that we are very negative in this inversion.
Yeah.
So you'll hear that term out there, inverted yield curve, and it has been a perfect predictor of recessions. And again, recessions, they are interest rates typically go down in a recession, and when interest rates go down, there ends up being some more buyers out there that are now able to go and afford a monthly payment. So more buyers, speaking of that.
So household demand, and this is national statistics. You guys know our local markets, so you guys know better than us, but this is to kind of give you an idea so that the trends seem to mirror one another. So household formations are typically about 1.7 million households per year. When interest rates got over 7%, people stopped buying. And so we saw less demand.
And when there are people that were hibernating, and we said that at the beginning, those normal people that would have been out there buying, interest rates went up, they hid away, waiting for those rates to go back down. And that's where the 1.3 is there. But the new housing supply, these are housing starts. So housing starts completed annually, 1.5 million, but we have to replace about 0.1 million a year. So our total new supply is 1.4. And we saw from the last slide, household formations at the end of last year, people out there buying is only 1.3.
And household formations are when people maybe move out from mom and dad, or they get together as a couple and they form a new household. And a lot of household formations are happening with first-time home buyers in that 30 to 34 year range, and they're the largest population out there. So,
and what we're going to see that as interest rates start to come down, and I think people out there right now are already starting to see people kind of coming out from that hibernation. As the interest rates come down, we're going to go back to that normal 1.7. Plus, we've got this lag effect. Those people that are hibernating still need to get out there as well. So our supply is really lagging, and builders have slowed down. So this is going to have some increased housing pressure for us as people throughout this spring come out of the woodwork and start looking at buying homes.
And so with home prices, what's interesting is we saw, over the last 10 years, nationally, home prices have gone up 115%. In the last 2 years, nationally, home prices have gone up almost 40%. Now, you guys don't know our local market, but we're seeing similar things happening here. Things are down slightly, but not nearly to the effect that they were back in the 2008, 2007 housing crisis.
And our market, we're not saying that it's perfect, right? Because this is an average, excuse me. And so I think one of our meetings yesterday for the Redmond area, they were down 2%. That's hardly a crash, as we said. And during a recession, home prices always go up, except for that 2008 great financial crisis.
So then we talk about affordability, and the media out there tries to talk about affordability and saying that homes are no longer affordable. And we want to kind of help break that myth a little bit. So in 2021, let's say somebody was buying a home for $400,000, an interest rate of 3.5%, and that monthly payment would be around $1,800. Now, 10% better now in 2022. So let's say $440,000 is that price. But now we see interest rates higher, let's say in the mid sixes or low sixes. That's a monthly payment that's about $913 more.
And that sounds scary. And so that's, a lot of the media, that's what they focus on. This is how much more expensive it is to get in a house in 21 versus 22. 22
However,
versus 21.
however, there's a component because household income has gone up. So in 2021, the average household income was 9,000. That was compiled by ADP. ADP though said that in 2022, if people stayed at their job, they on average got a 7.6 raise. If they switched jobs, they got a 15% wage increase. So average say of 9%. So that means then an additional 810, which seems to somewhat close the gap.
Except we still are dealing with inflation.
And so the cost of goods and services is higher.
So the average monthly cost of goods and services was about $1,100 higher because of inflation. Now, if we're conservative and say, okay, we're going into recession year, maybe wages only increase about 5% in 2013 or 2013. Sorry, I was looking, wow, I'm going way back. I was looking at that number 13. But if it only increases about 5% this year, well, a 5% increase is $1,300. So between the two, we're really not experiencing an affordability issue, or we won't as things improve in the market at 5% later this spring.
Yeah, so if interest rates go down, then affordability is right back to where it should be, and we should see then more and more demand. So here's what we see happening, and this information comes from a service called MBS Highway. We've subscribed to them for many years. Barry Hibby ran this. He had Mortgage Market Guide before that. So this is where this information is coming from. So we see lower inflation happening in 2022 or 23. We see a recession slow down. We will see incomes increasing to help affordability.
Maybe not as much as they were in the last few years, but we still will see, according to ADP, increase in wages.
Very tight inventory, not a lot of homes out there, and rents are still expensive. So we think that low single-digit appreciation for most of the US was likely to happen. You guys will know better about our current market.
And so here's a couple of the headwinds we have going against us. So we have talked about that quantitative tightening. So that's experiencing throughout the world. There's a lack of foreign central banking and buying
the bonds. Yep.
And we know there's more debt to be financed.
Yeah. So treasuries, they're issuing more treasury bonds and so forth. So those are some of the headwinds.
But got a lot of good things going for us.
Yeah. So we see lower inflation. We see excess retail inventory, resulting in less demand, lower prices, and increasing in mortgage service value as that
that chart that was showing us.
As investors are more confident that they can invest in those mortgages and that they'll get a return.
Which will decrease our mortgage rates and increase the amount of people out there buying. And over during the recession, which is, they say likely we're all 99% sure we're already in it, but rates decline during recession. So what does that mean? Probably by the end of the first half of this year, we're going to see rates in around the 5% range.
Yeah.
And
the 10-year treasury might be around 3%. So, this should result in strong options for your buyers, lots of opportunities. Stay positive because we see positivity out there. We're already seeing a pickup. We hope you guys are as well. Would love to actually, if you have questions, you want to put them in the chat box, or if you want to raise your hand, we can unmute or
you guys can unmute yourself and ask some questions.
Hey.
Hi, Patty.
Hi, I have a question because I don't remember this. I know, Tony, you've told me it probably a million times, but it's kind of a general rule of thumb. If your buyer wants to buy down their loan, what's the formula? That's
a great question. And different markets have different things. So in a normal market, oftentimes if somebody wants to buy their loan down, let's say by a 0.25% in interest rate, normally they might have to pay about 1 point in buy down, 1 point up front.
And
In a
your
normal
one point
is
is,
1% of the loan,
yes,
right? In a normal market. But what we've seen in our current market that's very different from other markets is that investors in the mortgage bonds, they know that they're not going to get those mortgage bonds in place for a long time. So what they're doing is they're requiring people to pay buy down upfront so that they, the investors, know that they're going to get a guaranteed rate of return.
it's almost like a prepayment penalty that they're hiding in buy down.
Yeah,
But because of that, we're seeing that you're getting more value for your buy down. So you might, instead of only getting a 0.25% for 1 point
of cost
you might be getting more like 0.5 to 0.75
of 1% improvement in rate for a point of buy down.
right now.
Okay, okay,
So that's one of the things that's changed dramatically.
okay. So if you wanted to kind of, if you're trying to figure out working with a buyer, there's some flexibility in your terms, in your offer. Would you? So if let's say the loan is 500,000, just to make it easy. So 1% is $5,000. And that might get you maybe 0.5 point, 1/4 to 0.5 point.
Yeah, maybe say
And about general rule of thumb.
Right now.
right
Yeah.
now, let's say maybe 0.5 point. Yeah,
Okay,
in rate.
okay.
And you can always reach out, and for all of your clients, the best thing they can do is talk to their lender and find out, have them run the numbers for them and see what it looks like on that day to at least get a general idea. And the markets are moving daily, sometimes multiple times daily, but it'll at least kind of give you a ballpark or give them a ballpark of how much buy down that they're looking at. So if, are you trying to think about seller paid concessions?
Yeah, I mean, it's what we're seeing out there in the market right now. I mean, goodness, in the last 2 years, I mean, a buyer had to pretty much say, you can have my firstborn child.
Yeah.
In addition, and what the money we have set aside for their college education. But now, you know, there's a lot more flexibility, but I wanted to make sure that I was doing the math right, you know, to say, well, 0.5 point might cost you about 1% of your loan value. I mean, it's kind of a, you know, 1/4 to 0.5 point, but okay.
And feel free to reach out to us
Yeah.
anytime. We're happy to run some numbers for you
Yeah.
on any of
And
those.
I do think, I mean, you folks just put out something about if you use you now as a lender, that you can refinance at basically very low charges or no lender fees, but there will be fees, of course.
Yeah, and that's actually a good point, Patty. We've introduced a program at Axia that's encouraging people to buy, because we're then giving them a certificate that allows them to refinance within the next 3 years with Axia. And
That's
if
a
they,
long time, 3
Yeah.
years.
and if they refinance with us, then we will waive the lender fees that we normally charge.
Yeah.
So, yeah.
And the reason why we're doing that too is you guys saw on that chart, the expectation, and you guys have probably seen this already, is the market is starting to pick up already. The last few brokers that have had open houses that we've talked to, so they've had more interest and there are more people coming into their open houses than they had in the last few months. So we're already seeing that market pick up, and as that market pickup happens and the demand or the supply comes down, the increased demand, it's going to switch and not be a buyer's market, as much of a buyer's market anymore. And
We're
so
going to go backwards. We're going to go back to what we happened last year and in 21 and 22.
Yeah.
Actually, 20, started in 20.
and that's why
So-
we're really encouraging people to get out there
In
now,
the next 2 months, yeah.
because
Get ahead of it.
it's better to pay a little bit more in interest right now but end up not having to pay, you're not being a bidding war and paying 20, 30,
Or-
100,000 over asking
Or
price.
waiving protections, waiving inspection.
Right.
Release enforcement, things like that.
Right. So our arms, at one point in time, they were a nice alternative, but I am wondering if they are at this point in time.
Great question.
That's a great question. So when we talk about the inverted yield curve,
Mm-hmm,
where short-term interest rates are
mm-hmm.
actually normally lower than long-term interest rates. We're having that yield curve inversion happen,
Oh,
where shorter-term interest rates are higher
yeah.
than longer-term interest rates.
Okay.
So there's typically not any benefit in the current market because of that yield curve inversion.
Mhm.
And what that's gonna do is people will have to buy down to a certain point in order to do the arm. And so
That
if
doesn't
you,
make any sense.
Exactly.
That doesn't make any sense.
and so what's happening is that we're in a normal market, people, maybe they're gonna do an arm because there's not as much buy down to get to that rate, because it's then gonna change over the next few years. Well, investors already know that that arm is going to be refinanced. So they're making that arm rate more expensive because it'll never get close to where it's gonna be switching to a higher rate.
And probably when arms were really great was when interest rates were like, well over 10%, 12%. That's where it started, or 18%, as I recall. And that's where it made sense. Oh, it's not going to be 18%, it's going to be 13%. And then it would go up from there.
Yeah.
Right. Yeah.
And that's something, and people were really big on arms last year and the temporary buy downs, and temporary buy downs are still okay, but it may not be as much of a factor as we're moving forward, because rates are going to become less of a driving motivation.
Okay, got it. Thank you.
Of course.
Thanks for the question.
Yeah.
Yeah, thanks. I'm glad to have the information on it. That's wonderful. Thanks.
Our pleasure.
Any other questions we can answer for you guys? Well, if that's the case, then what we'll do is we'll sign off. Thank you all for joining us here. And then once again, we're going to send out this recording to people as well. And we, remain positive. There's opportunity. Encourage your buyers. Now is the time to get in before the mayhem starts.
And it really, as you guys kind of saw from those graphs, May CPI number, so May 10th. So we talked a lot in the last fall about November 10th. We're back into the May 10th is going to be another probably big influence on the market. And so getting your buyers out there before then, because probably after that, people are going to be really encouraged to go, and there's going to be more demand.
And we're going to see interest rates continue to go down. It won't be a straight line, choppy line, but they should continue to go down. And at some point, everybody will start saying, oh, let's get back out there.
Prakash?
Yeah, thanks, Tony and Brenda. Thanks for the session. It's like very informative. Along with the video recording, could you please share the presentation deck as well, if it is okay?
Absolutely. Yeah,
We can do that.
happy to do that.
Thank you.
Of course. All right.
Okay, guys. Well, enjoy your day. And we're here to help anytime you have questions or your buyers have questions. We love to be a resource. We love working with you. And we appreciate everything.
Yeah. Thanks for your support. And we'll look forward to doing more updates, and we'll keep you posted. Thank you so much. Thanks.
Thanks.
Bye, Lee.